Hey guys, it's Ryan Barnes here, your personal economist. Um, let's talk about Tesla today. It's down 41% year to date. So, buying opportunity or complete trap? That's what we're going to talk about today. So, I want to talk about Tesla, and its market cap is currently at $730 billion, which is significantly down from its $1 trillion market cap earlier in the year. And so, what I want to do is I want to understand whether or not Tesla is a good buy right now, or whether we should say goodbye to Tesla. So what's going on with Tesla? Let's talk a little bit about the company itself and the way that I see Tesla in terms of its in terms of the company. So the number one thing that I think about when I think about Tesla is a battery company. And a lot of the initiatives that I see from Tesla are really initiatives that are designed to get you to buy a battery, a big, giant battery. So obviously they sell cars, they sell electric cars, and those electric cars come with giant batteries to power the electric motor. They've also got this energy sector of their business where they sell solar panels. And along with the solar panels is a Tesla Powerwall, which is basically the battery that you have in a Tesla car hanging on your wall. It's just another way to sell a battery. The other thing that I'm looking at is Tesla's got they've got this robot that they're developing. And again, the way that I view that is if you buy their robot, the robot's going to have a Tesla battery inside of it. Tesla is a battery company that produces other products that they can shove batteries into. Now, they're also talking about getting into some other things with the car game. They're talking about doing things like robo-taxis. They're talking about AI. They're talking about to power those robo-taxis plus AI to do other things. Tesla's also talking about a bunch of other stuff. So there's a lot of growth going on with Tesla. There's a lot of opportunity for growth. And Tesla itself says that they're targeting 50% per year growth on their stock, on their revenues, their profits, all of that sort of stuff. So the question that comes to mind is, all right, let's start by taking what Tesla is saying about all these growth opportunities and what that means for them to actually grow. And let's just check it out, see what kind of evaluation that we can come up with. So let's start by looking at their free cash flow. Their free cash flow per share at the moment is, for the trailing 12 months, $6.41 per share. Sorry. I misspoke. It's $6.10. Looking it up right now. So that's ending March 2022. All right. So $6.10. That's a lot of free cash flow per share. Very, very impressive numbers. And so we're going to start with that $6.10, and we are going to we're going to let that grow at a compound annual growth rate of 50%, which is what Tesla, the company, is saying that they think that they can achieve. And we're going to let them do that for 10 years. And then I'm going to have my personal required rate of return be 15%. So when I do that and we calculate that out, we get a fair value for this company of $867.20. That's just math, right? If you take $6.10, let it grow by 50% a year for 10 years, and then you have a terminal value for the company as well. That's what you end up with and my terminal value is I'm going to take the final value and I'm going to let that grow for 10 years at 4%, just so that you know where my numbers are coming from. So that gets you to a fair value for Tesla of $867. Current price of Tesla is $705. So based off of this, if you believe that Tesla can achieve 50% growth per year for the next 10 years, Tesla looks like a great opportunity to make 15%. There's a margin of safety there and all that sort of stuff, right? However, if what you take away from this video is that Tesla looks like a great buy, you should go buy it, blah, 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 you are going to miss the point because you didn't follow all the way through to the end of this video. Because I want to talk about some things with Tesla itself. I personally don't think that 50% growth per year, that being the compounded annual growth, is a number that is achievable for Tesla. Seems very, very high to me. It seems almost unrealistic. And the reason why is because that sort of assumes that Tesla performs perfectly. And not only does it assume that Tesla performs perfectly, it's assuming that the economy as a whole across the globe cooperates with Tesla. And I don't mean that people are trading and supply chains, blah, blah, blah. No, I'm talking about recessions, right? For one thing. Here's the thing. Tesla has not been around long enough as a public company to go through a recession. It has never been in a recession before. We don't know how the Tesla brand is going to react during a recession. And a recession is going to come eventually. Could it be this year? There are a lot of people think that there is going to be a recession this year. But it doesn't necessarily have to be. It could be in year 5. It could be in year 6. It could be in year 7. You don't know. So I think that picking a number 50% growth, that is incredibly optimistic. I think that even if you want to be incredibly bullish, even if you want to be super, super bullish on Tesla, you should not assume any more than 30%. And that is the top mark of what you should be taking for Tesla. Really, it is, it's really, really, really high. 30% free cash flow growth per year. So if you toss that into this calculation, leaving everything else the same, 30% free cash flow compound annual growth rate will only get you $250 per share. And at those prices, Tesla looks incredibly overvalued, crazy overvalued. And I And that is an incredibly bullish scenario. 30% growth year over year for 10 years. I would rip off my arm and sell it to you for the opportunity to get that, right? At the right price. But at today's prices, that's all baked in. It's already there, right? There's no money to make at today's price. It's 3 times more than what it's worth today. That's incredibly overvalued. And trust me, I get it, right? I started this video off by talking about how Tesla has all of these amazing growth opportunities. They've got robotics, they've got robo-taxi services, they've got insurance, they've got their car business, they've got their energy business. All of these things are there to support their battery business. Like, I get Tesla, don't get me wrong here. I just don't trust that Tesla as a company can either achieve 50% growth every single year for the next 10 years, or that the wider economy is going to cooperate with Tesla growing 50% every year for the next 10 years. I think that, yeah, they're going to grow and they're going to grow fast. But I mean, I want to point this out, right? Fair value is all about growth and what assumptions you make about growth. Even a very bullish 30% growth per year, we're talking, let me put that into perspective. That is doubling every 2 years, right? At 30% per year. So, I mean, just about, give or take, right? It's doubling every 2 years. That is incredibly fast growth. Crazy fast growth. And Tesla's still overvalued for that kind of growth. And that's that's sort of top of the mark of what I can see as being realistically safe, right? And even then, I'm not 100% sure about that. That is like, I would be very, very nervous buying for a 15% for a 15% per year compound annual return, trying to assume that I have to make 30%, not talking about 50%. I'm talking 30%, right? We're talking, you have to really, really believe, because if you don't, 15% is just not enough, right? There's too much risk for that kind of a reward. So the question that you could have is, you can say, well, let's discount how much it's going to grow some more. 25%. Great. Now it's $183 a share, right? What it's worth. But that, that's not good enough. What if you said it's only going to grow 20% a year, and that's all that I have confidence in? Now you're talking $130 a share for Tesla. And this is, and we're just talking straight math here, right? And I think 20% is probably more realistic, frankly. But would you buy it $130 a share? No. Sorry about the clock. It's going to ring 9 times now because I'm recording this at 9. Cool. right? So would you buy it at $130? So what we were talking about was the price of Tesla, assuming a 20% growth rate. I think 20% is more realistic given all of the things that could happen with Tesla, right? That could happen in the wider economy that affects Tesla, right? What happens if something out of Tesla's control happens, right? What if a hurricane or an earthquake or a tornado or something else, some act of God comes and wipes out one of their factories, right? Like, what is that going to do to Tesla, right? Any setback, right? So you got to factor that into your growth rate. You can't assume that Tesla is going to hit the most bullish case. You have to pull that back a little bit. And then when you do that, you don't want to buy at fair value. You want to buy below fair value. You want some sort of margin of safety to fair value. And so you come in and you go, okay, if fair value at 20% growth is $130, I want to pay $100 for Tesla. And so if $100, and again, the point here isn't that you don't see the growth potential in Tesla. The point here is that you want to be conservative, right? The point is that you want to make sure that you are not being so aggressive that you're making mistakes. That's the number one problem that you see in the stock market, is that people get aggressive, they get antsy, and they start doing things, and they start doing things that they shouldn't do because they get impatient. And so and I'm guilty of that, right? I do that all the time. I did it this year, right? In January, I got very impatient and I started buying, knowing full well that I was paying closer to fair value for one of my stocks that I'm buying, and knowing full well that things were probably going to deteriorate. But I bought, it was fine. I'm down on that position, and I'm just continuing to average down on that position because now it's below fair value, and it's where I should have, frankly, started. I should have started buying now, and I should have just been stockpiling cash. But that's beside the point. The point is that if you get impatient and you start buying things because it looks like a good deal on paper, it looks like you're at fair value, then you're going to be making mistakes, right? You're more likely to make a mistake, is the point, right? You're more likely to get it wrong if you are impatient and you do things that you shouldn't do. Now, I'm not saying that Tesla's not going to grow at 30, 40, 50%. I hope that they do. I think Tesla is a fantastic company. I think that they have lots of growth potentials, lots of different avenues for growth. I just don't want to, I want to be more conservative than what the current price implies. And if you don't want to be that conservative, that's fine. Just understand that that means that you are accepting a lower rate of return, which is completely acceptable, right? Just out of curiosity. Yeah, so depending on what your assumptions are, you could get like a 1% rate of return at I don't know, 23% growth. Yeah. So at today's prices, if you're willing to assume a 23% rate of return, a 23% growth rate in Tesla's free cash flow, compounded annually for the next 10 years, you would be getting a 1% return. And if that sounds good to you, and the growth rate makes sense to you and all that sort of stuff, then fine. But I want to switch gears a little bit. Let's go back to this idea of a 50% growth rate for Tesla. Let's just say that you don't want to discount the growth rate. You think that, yes, it is going to grow 50%. But because of the things that I'm saying to you about, the economy and whether or not Tesla will hold up in a recession, and you have some fears along that, but you really, really want to say, hey, Tesla's going to grow up 50% a year. What's another thing that you can do? The other thing that you can do is you can just say, hey, there are some risks with this 50% number. So I'm not going to discount at 10, 15%. I'm going to discount at 20, 25%, right? So at a 20% required rate of return, so that you get a little bit more margin of safety, we're talking $530. If you're requiring 25% return, you're talking $347. And that's one of the things that I want to point out, is that you could actually be very bullish on the growth, but you see a lot more risk. The higher that growth rate, the more risk there is that Tesla wouldn't be able to achieve it, right? So what you want to do is you want to discount that back heavier if you don't want to change your growth rate, right? Because there's more risk. With more risk means you should be taking more reward. And the thing is that, and I would say never go below 15% required rate of return. That's just me personally. I think because you can get, if you just buy S&P 500 index funds, that's your next best alternative to picking individual stocks. And the market has returned on average about 10% a year. You probably should get some sort of premium over that. If you're going to be going through the process, you should probably require 15%. Some people say 12.5% is fine, or whatever. You're taking an additional risk. You should take additional reward. And if you're going to be basing your projections on 50% growth per year, you should probably discount heavier than 15%. And because there just is more risk, right? So that's sort of my thoughts on Tesla. I think that if you could get Tesla at $100 a share today, I think that it's a strong buy. But at where it's at right now, at about $700 a share, guys, I wouldn't buy it. But that's just me. So take that for what it's worth. It's just my opinion on the value of the stock. Do your own research, plug in your own numbers, make your own assumptions, and start plugging in different numbers for required rates of return and for growth rates, and find a number. And once you've sort of made those assumptions and you feel comfortable and you're happy with that, that'll give you a number. And if that number's good enough for you and the stock price looks good, buy it. But for me, Tesla's a hard pass at today's prices. Now, price comes down, stock market crashes, might be interested later. I don't know. I like Tesla as a company. I think that they do have amazing growth ahead of them. I'm just not willing to pay the price that the market is assigning to the stock at the moment, because I think there's just too much risk there. Other people can disagree. They can start buying in. That's fine with me. I'm going to sit back and wait on this one. All right, much love. Talk to you guys later. Peace out.